I would have liked to see that candle come down, test the volume balance. That would be nice to see that before taking out the 5. And then rip into 41.18, 41.21 and a half. I would want to see it now. And why am I saying that? Because we've already started the run and we went above the bodies of these candles. Do not consider this series of 2 down close candles as a bullish order block. Now let's see a support price around here. You can come back to this candle's high. But I'd like to see that stay open. See that? You can see that right there, stay open. You can touch that opening of that candle and then rip into 41.18, 41.21 and a half. And then your 15-minute ES chart, you're going to have 41.33.75 noted as well. That's the high end of the 15-minute fair value gap, which is a city. I'll show you on the chart in a minute. I was looking at it. Here's the 41.18. It's the 15-minute candle at February 9th, 2023 at 12:30. The time interval there. So if you look at the 15-minute time frame. It's right here. So if you're looking too close and you have your candles so drilled in, you won't be able to see this or appreciate the levels that it's going to likely reach into. So we're dropping that 15-minute fair value gap. And you want to get your level in the middle, which is constant encouragement. So 41.28 even. Have that annotated on the chart as well. And when I have something like this, you want to split it once more. And you'll have a gradient of 4 levels. So we're going to look at 41.25.25 and 41.28.25. If we were to get a blow off and move to the upside, this fair value gap on the high end here, 41.32.75, that would be my morning session high objective. Should it reach that, I'd be content to move to sidelines. I'm already feeling is that US 500's not being annotated as frequently as some of you would like me to do. It's very difficult for me to focus, I apologize, but at least you can see the difference in what the US futures contract is doing in respective highs and lows. I'll put the 18 up on US 500. US 500. And lows. I'll put the 18 up on US 500. So you have 41.18.6 for your constant encouragement. That's the fair value gap on US 500. So just make sure you have that measure on your chart. Those are fine on the safety on the right hand side. So you can see how watching in the morning using the opening range, not rushing, not trying to get in there and make a decision right away. These types of price runs, they're not essential for you to be a part of, especially while you're learning. Can you guys give me a shout back at me on Twitter if everything's coming through? My audio is okay. The chart, is the chart clear? Give me a 5x5. Tweet to me if everything's good visually and audibly, please. I'll give that to me. Okay, I think that's me. Help Foxy. And yes, from running Yango. Hello, Ronnie. Thank you, appreciate that. Now let's go back to that fulcrum point I was showing you when we're looking for expansions. Because we're already through the buy side and we're inside of that old inefficiency on the 15-minute time frame from February 9th. So since we're in between the low and constant encouragement or midpoint of that 15-minute gap on the 9th, the 12:30 candle, on the 15-minute candle, respectively for that day, February 9th, and you have this level here, what you're going to do is drop your fib from the low up to the high of the wick, because we can use wicks for measurements of range and targeting. The only time I'm using a wick for entries is when I'm using constant encouragement or the quarter point of that wick. Those are two most important levels for me on a candle's wick or a candle's tail, the part that goes below the candle. This is usually referred to as a tail, and the wick is usually the upper portion above the high. So we have a standard deviation of -2 here at 41.26.25, then constant encouragement. And then we have 41.30.50, and then -3 standard deviations at 41.34.5, which is outside the spectrum of the February 9th fair value gap. So I'm not really interested in that one because it's, in my opinion, all the results for today. If we can hit constant encouragement, that's satisfying for me for the morning session. Now looking at the run from 950 right here. So the market trades back into an order block, and 950 to 1010, that's a macro. It's likely to do what? We were looking for a price that reaches into 41.18, 41.21 and a half, and then also into this 15-minute fair value gap. This price supported here, that's what I'm watching, at the low end of that 15-minute fair value gap. If it starts to run, as soon as it hits this level, should it do so? I don't know if it's going to. Should it do that, you want to screenshot your chart as soon as it does that. And then log it and annotate what you've observed this morning. You're managing and developing patience when you're tape reading. There's no animation in my voice. I'm not terribly excited or shocked. I'm not risking anything. I don't care about being right or wrong. All I'm doing is pointing out where the market's likely to go. When it fails to do certain things, I'm making that observation with you, sharing what it should be doing, what it shouldn't do. And we're still, as much as this might look entertaining to some of you, this is still very, very ugly price action. Still can be traded, obviously, but it's ugly. And when the charts get cleaner, watch this little inefficiency here. When price cleans up a little bit more, and it will, you'll see how fun and precise things are. It just becomes really, really easy to see the setup. You can't hide it. Not that they're really trying to hide it here. I don't want you to read too much into it when I say that. It's just hard to ferret out the really low risk, high probability setups in environments like this because you get a lot of chop, retracements, a lot more movement against your position entries than you would like to see in like easier market conditions, which you'll understand later in the year. By contrast, days like this versus days where you see the outline move where it should move, where it shouldn't move, and it just takes off runs. Real nice and sharp, no real deep retracements, almost like immediately in the money. That's a low resistance liquidity signature. So that's really what I'm trying to teach you this year. But we have to work in every individual daily range to fully appreciate what it is that makes a low resistance liquidity. When I first started teaching my older students, they were hard pressed to understand what I meant by that because we were doing live sessions and I'm trying to communicate the signatures, what it looks like and what it doesn't look like. And when you have a group of people that come into this, when you spoon fed, give me a signal to buy, give me a signal to sell, where's my targets, where's my stop at? Then that doesn't satisfy right away. When it doesn't satisfy a student or a viewer like that, they have a hard line opinion. Oh, it's a scam. It doesn't work. It was never promised as a signal service. It's to teach you how to read price action. And that's what I'm promoting here. So all I'm doing is helping you read. If you can read price action, you're going to learn what your favorite setup is. By default, it's going to happen. So what I just did here was we had a retracement down into a fair value gap. What kind of fair value gap is this? Buy side imbalance, sell side efficiency. Up close candles that create a fair value gap is a BISI, B-I-S-I, buy side imbalance, sell side efficiency. We had the sell side offered here on this candle. This candle's high comes in at 4120.50. This candle here, its low comes in at 4120.25. 1/4 of a point, one tick outside the fair value gap. That's permissible. That's reasonable. It's not upsetting anything. But that's also the signatures of a day like this. Where I mentioned before, the precision is going to be slightly skewed because tomorrow is the real event. That's the real event. That's the thing everybody's waiting for. So it's going to be a little bit less perfect on a day like this. Much like the reasons why you might try to justify why I don't trade on the Thursday and Friday not payroll. Because it's like this, where it can be just a little bit outside the lines that I like to see color inside of. But what I'm showing you here is, should we run higher and take out the high? Look at the left. Isn't that convenient? So we have relative equal highs here. To me, I view that as engineering liquidity. Don't be surprised if they take it below this low now, because that'll sell the idea that this is a top or a resistance level. And if we take it below this low here and trace down to this fair value gap here, look at all the back and forth in here. See all that? That to me is a balanced price range. So, meaning, as much as I'd like to see this stay open and act as a breakaway gap, if I was bullish, I have no position on it. But I'm making a case for arguing if I was already long down here, I'd want to see this left open, do all of the reaccumulation of new longs here, and send it above these highs. But I'm willing to accept the fact that because they now priced in a relative equal high, these two highs being basically the same, if they take the short-term low out here, then it can come back into here, which is, again, one of the reasons why I teach not to trail your stop loss up, because you don't know when these fair value gaps are going to form. You're too new. You have no idea when they're going to form. I usually have a pretty good idea where they're at, because I'm familiar with the range I'm trading in. And because of signatures like I taught last week and before, we're using PDA rate matrix when it's in a premium to discount, just like there's a threshold when you don't want to add new pyramid entries, there's also a threshold that you want to see price move beyond before you consider moving your stop loss up. And I'll cover that this year, don't worry, but we're not even in entry points yet. Right now you're just trying to reprice, because you don't know where it's going to go, or where it's going to try to gravitate to. It doesn't matter what your entry strategy is going to be, it's going to be probably wrong. But if we can trade above these relative equal highs, we have a standard deviation of negative 0.5, which is just short of consequent encroachment at this level here. So at 4127.50 and then 4129.75. So let's assume that it does find its way up to this level, midpoint of the 15-minute gap on February 9th. This would be my objective for the morning session, and I'd be content. If it goes through and expands, we always have the probabilities of it reaching to the high end, but I don't believe that's something that we should look for this morning. I could be proven wrong. But it goes through consequent encroachment, it could go to this level here. So what I'm always doing is I'm getting measurements, not doing classical fib ratios to get, like targets. Like you see anybody that teaches Fibonacci, they'll teach you fib ratios that supposedly the market's moving towards. These levels here are standard deviations, and you're going to find that they're going to serve you better over time when you understand the narrative of where price should go and with liquidity, and coupled with inefficiencies when they exist in price. In plain terms, these are going to be better for you than the classical retail ratios that Fibonacci levels are usually attributed to. Which is why you see people trolling over the years. You don't even use a Fibonacci rate. You're right, I don't use it like retail. Proud of it. So, in your mind, you should see these relative equal highs here as a buy-side liquidity pool. Now we took out that short-term low. So anyone that's being short or going short, they now have their stop loss right above here. What kind of stop loss? Buy stops. Which is why I write buy-side liquidity. Still start with eyes are old. And into the top, left. And it's large. Okay, so we want to keep this fair value gap annotated. Just extend it forward. And in here, why do you sometimes use lines and sometimes you use rectangles? When it's in close proximity to one line like this, it helps me keep my frame line when I'm teaching you. So as I'm annotating charts, I'm a trade example I'm showing you, I'm going to make sure that I'm not going to get confused as to what I'm looking at. Because if I have too many things on my chart, it takes away the purity of reading price. So like I said, it's very difficult for me to keep my focus and talk to you about what it is it should do and shouldn't do. But I mentioned if we take out that short-term low here, we can dig down inside this fair value gap. So far, we're seeing institutional overflow entry drill, which is a partial entry into a gap, which is a fair value gap here between this candle's high, this candle's low. What kind of gap specifically is this? A buy side imbalance, sell side inefficiency. Buy side was offered, it's inefficient in what? Sell side. But if it's bullish and they're going to run on retail that are, in my opinion, being introduced to a potential shorting opportunity for them, and they trust when they see these types of things here, that double top type thing. It looks like the textbook version of what? Resistance. And if they drop it down below a short-term low, what do they see that as? That's a market structure shift, or it's a break in market structure. And that may be true, it might happen here. But I like to look for periods where there's an arm wrestling match between these two categories of traders. Yes, this is reasonable to trade back down here. It didn't even go to the midpoint of this fair value gap, which would be consequent encroachment, because it's a gap, not a candle or order block. If it was an order block, it would be a mean threshold. Because because it's being identified as an imbalance, we didn't even trade down to the midpoint of that. So let me show you what I mean by this. Between this candle's high and that candle's low, we have a price point level of 4118.75. So we didn't get down to that level here on this candle. This candle's low comes in at 4119 even. So it's 1/4 point higher than that of the midpoint of the gap, which is 4118.75. Because it didn't go down midpoint, this is viewed as institutional order flow entry drill. I know it's a mouthful, but it just means that if you're bullish, if you think prices are likely to go higher, I'm not suggesting that you should be long, but if you are expecting prices to move higher and you see a fair value gap, and you want to see a level of imbalance like this stay open, which would be the argument if you're bullish. Okay, if you're bullish, you want to see it try to reach up in the consequent encouragement. Because we have time, look at time left still. The New York time, so we chart should always be on trading view. It's 10:16. So there's a little bit of time left still, and it can expand up into the take the buy side out, up to it, through it, and maybe hit consequent encouragement. And that'll be a wrap for one session, and I would consider this a profitable endeavor over charts. But because we only came down partially here, the idea of leaving some of this open, and I don't recall now because I've been looking at this chart on the left-hand side and going back and forth and trying to keep my thoughts collected as I describe what it is I'm looking for. I don't recall, but I think I did, and you can correct me if I didn't. I believe I said I want to see this fair value gap left open before we see this traded through and maybe even hit consequent encouragement. If I didn't say that, just know that I would have liked to have said that, because that's what I would expect. I think I did say something to that. Again, you can go back and listen to the recording. So I mentioned how legacy has the breakaway gap. I know I said it because I want to see that stay open. Breakaway gap is just like a signature where you can see price really snapping higher and having no real immediate interest to come back in to reprice over top of all of this. That's sometimes very indicative of seeing higher prices. But because we've met a 15-minute premium array in the form of that fair value gap, we dug into what? Did we meet the lower quarter of that? Just about short of the quarter level of that fair value gap on 15-minute time frame. We keep coming back into this fair value gap. The fact that it's doing what it's doing right here is also another reason why I'm teaching and preaching to you caution on a day prior to like news events like non-farm payroll, FOMC, and like tomorrow's CPI number. This type of price action is a classic delivery in price, where it's just a lot of hurry up, move something, move somewhere, and then chop around a little bit and drive you nuts. Because you just want to get out of the trade. You just want to get the trade to go to your target, be done, and be over with. Unfortunately, when you're trading ahead of high impact news drivers like CPI number tomorrow, non-farm payroll, FOMC, something to that effect, you'll get trading conditions like this, which makes it high resistance. So high resistance liquidity runs. We're looking for a run into the imbalance midpoint at 41.28 even. That's my objective for the moment. Should it hit that, I'm going to do moves like Jagger for my wife, and she's going to be like, whatever, you didn't take the trade. But for learning purposes, you'll see that this is what it's like to be delivering in high resistance liquidity run signatures, or condition not signatures, where it's really, really frustrating sometimes before it gets to your objectives. And another one would be how we failed just 1/4 point, one tick, before getting to the quarter level of that 15-minute fair value gap. On another day, it would have ripped right on through 41.28 even, and probably even climbed all the way through the high end of it, being this here. Okay? But all of this right here is what you're going to endure if you force yourself to trade in conditions that are high resistance. High resistance doesn't mean like support resistance. It means it's resisting clean price runs where they just run big ranges, speed, efficient run right to where you want to go. That's how you want to trade. You want to trade in those conditions. But as a neophyte, someone new to trading, not really versed in price action, even if you are profitable in trading for a long time, it's probably something you really never pay attention to. There are times when the market gives you these very stagnant types of conditions where, yeah, if you have a really wide stop from your entry, don't ever really move it, and just endure through the entire session or the entire day, your target's going to get hit. But because you're not sitting in front of the chart watching every individual minute candle, it will be very frustrating. And for a new student, what I do is I take them into the charts and show them by contrast, this is a high resistance liquidity run condition. This is what we can expect and what you would endure, so that way they can feel what it feels like to be in that. Like it's a lot of time. It's moving very, very lethargic in a small little range before taking out buy side liquidity. Whereas you would have rather wanted to see what? It trade down to that blue rectangle and then volley higher, ripping through the buy side and touch 41.28 and swing our checker flag and we're all happy. That is not an immediate gratification in conditions like this. You get that type of immediate gratification, immediate feedback that you're on side, the right side of the marketplace, in low resistance liquidity runs, where it doesn't do a lot of this consolidation. It's in a hurry to get somewhere. It's in a hurry to get there quickly. And if you're on the right side of the marketplace in those conditions, it's very satisfying. There's nothing more satisfying than that. See how it just went up there and just got real close to the buy side, and then we're going back down to the low end of the fair value gap. This is the stuff you want to record in your journal. You don't want to say, this is so damn frustrating. You don't want to do that. But you do want to observe the length of time that it takes, and maybe ultimately a failure. It doesn't mean it's going to go, I don't know for certain if it's going to go above that 41.25 and clean that buy side out right now. They could leave it just like that, retrace, and then later on in the lunch hour, or on the side of the lunch hour, like through that buy side liquidity. That's the problem that you're going to encounter trading in these environments, versus when the market's really obviously loaded up to go in one direction over another. It's one-sided is how I teach it. If you can justify the trade only in one direction, that is my ICT definition of high probability. And that high probability condition is what we refer to as salad days, easy day trading. Like easy, get in, get your money, go home. Whereas now, when you're in these types of environments, you're working for it. And at the end of these days, even when you're profitable, you feel like you've worked out. You feel like you're drained. You just want to take a nap, relax. You're not even want to look at the chart because it's drained you. Because you're taking a lot of time and energy and you're burning a lot of calories. Your brain's doing a lot of calculations, what if thinking. You're anxious. You're running all kinds of scenarios. What if I don't take my partial here? What if I don't roll my stop up here? What if it comes against me and digs in, takes away 40% of my profit? How will I feel if I don't take my profit here? What happens if I do take my profit here? And it runs the buy side and goes all the way to the top of the fair value gap. That's what you're going to encounter, and you want to observe all of that. That's the whole point of me sitting with you at the top of these charts, because that is how you learn. Because you're going to discover a lot of things about yourself that you probably thought you were very strong. Your will was strong. You're very disciplined. You think you're disciplined. You think that you know what you're doing. But when you're forced in front of charts like this, they are a mirror. They're going to show you who you really are. They're going to show you all your imperfections. As wonderful as they are, that make you unique, you have to refine many of them as a trader and keep them from manifesting themselves in your charts for your trades. And that's not easy to do. And I'm not guaranteeing that I'm going to be successful for everyone in that regard, because all of you have your own individual personalities. And there's character flaws that all of us have. They may be viewed as a cute little quirky thing that your spouse or significant other likes about you. But in the markets, they will serve you. You're in. So you have to be mindful of that and understand that a weakness is not something that makes you a bad trader. It just means that you have something to improve upon. And you have to develop coping skills for some things, which my coping skill that I needed right away when I first learned how to trade was the fear of getting in. That I needed to know that what I was using to get in the trade was worth even employing. I discovered also here. So I understand you were mad at me. Can you just go over to the 1 minute chart so you can see what's doing? You can see what the US 500 chart's doing on your end if you follow along that. As long as you can see what the US futures market, the ES on the right hand side is doing comparatively, you should be fine. Don't do this. No, don't do it. Buy sense about to get spanked. No, this one. Alright, so we have 4118.6 for US 500. See what ES is doing? See how it's just sitting there crouching below